All right, so California, Florida, Colorado all have increasing insurance costs, and they're pushing people out of home ownership and into foreclosure. Here it comes.
Skyrocket after the Marshall Fire, and that's why Utah has now appeared on the same internal risk lists. But while wildfires get the headlines, they aren't the only danger. The second risk is harder to see until it's too late. Southern Utah has been hit with back-to-back flooding events that defy historical patterns. St. George, Moab, Zion Canyon, and multiple regions in Washington and Kane counties have all experienced destructive flash floods. These aren't river floods caused by slow rising water. These are sudden violent storms that dump massive amounts of rain in minutes. The ground can't absorb it. Neighborhoods flood instantly. Damage costs spike. Insurance companies study these patterns obsessively, and within just a few years, Utah's projected flood risks have been updated multiple times, each revision showing higher and higher danger levels. Homeowners don't see those maps, but insurers do, and when those maps turn red, companies begin restricting coverage long before the public realizes what's happening. This combination, rising wildfire intensity and accelerating flood danger, has put Utah in a rare and dangerous category, a state with growing population, growing housing demand, and growing climate-related risk. For insurers, that's a perfect storm. Many Utahns are already feeling the pressure. Some homeowners say their insurance jumped from $1,200 a year to nearly $4,000. Others received cancellation notices with no clear explanation. Some were pushed into the Utah Fair Plan, the state's last resort insurance option, which was never intended to handle a large share of the population. It offers basic protection, not full coverage, and it comes with limitations that most homeowners don't realize until it's too late. And then there's the mortgage problem. Because in Utah, just like in every other state, you cannot legally keep a mortgage without insurance. If your policy is canceled and you can't find a replacement, your lender will buy force-placed coverage on your behalf. That coverage is often double or triple the cost, and it protects the lender, not the homeowner. If you can't pay it, you risk delinquency. And for some families, foreclosure is not far behind. That is why this insurance crisis has become a political crisis. Governor Cox is being pressured from every direction. Homeowners want answers. Real estate agents fear the market could stall. Builders warn that new construction could slow dramatically if insurance becomes too expensive or impossible to obtain. And economists caution that Utah's housing market, already stretched thin, is more fragile than it appears. The connection between insurance and housing stability is deeper than most people realize. When insurers pull back, home values begin to fall. Buyers hesitate to purchase homes in areas where coverage is unstable. Lenders refuse to finance homes in high-risk zones, and entire neighborhoods can lose value simply because one or two companies decide the risk is too high. What's happening in Utah right now may look small from the outside. A few cancellations here, a few rate hikes there, but that's how every insurance crisis begins. Quietly, slowly, almost invisibly, until one event triggers everything at once. To understand how quickly these situations can escalate, Utah only needs to look at its neighbors. In California, the insurance crisis unfolded so rapidly that some counties saw insurers withdraw within months. In Colorado, a single fire destroyed more than 1,000 homes and permanently reshaped the insurance landscape. In Florida, entire companies collapsed and left hundreds of thousands of people scrambling for coverage. The blueprint is identical every time. Insurers limit coverage quietly. They stop offering new policies in selective zones. They refuse renewals in areas where risk models shift. Premiums spike, withdrawals accelerate, housing markets destabilize. Right now, Utah is edging dangerously close to the middle of that sequence, and with every new wildfire season, every sudden flood, every rise in construction costs, and every billion-dollar disaster across the West, one question grows heavier in the background. What happens when the next major insurance company finally decides Utah is too risky? Because if the internal models used by national carriers are correct, the biggest shift Utah homeowners will face hasn't happened yet. It's the one that hits suddenly, the one that spreads statewide, and the one that targets the group Utah believes is still safe. The homeowners Utah believes are still protected are not the ones in the mountains or the desert or the rapidly growing rural counties. The group most at risk right now is the one no one ever questions, the group everyone assumes will always have coverage. It's the suburban neighborhoods, the quiet subdivisions, the new communities with identical rooftops and fresh pavement, the places where families move for safety, comfort, and stability. The very places insurance companies once relied on for consistent profit, and those areas are now appearing in risk models in ways that should worry every homeowner in Utah.
Okay, we're going to end it there. Hopefully it will not come to that, but it could. And if it does, they're going to feel it in a lot of ways. A lot of ways. So, God help us. And they're not alone. Because you got California, Florida, Colorado, Utah. Who's next? Also in this model. Climate changes, forest fires. I know here in Montana, if you don't clear your property, your rural property, and get trees and brush cleared away from your home, I think you're at a higher risk for insurance, and I don't think they'll cover you. And the state has been pushing for rural homes to make sure that they have enough trees and brush cleared away from their homes that they are not in a problem with forest fires. So, there we go. Good day, and God help us. Another financial blow to homeowners.